When engineers build a suspension bridge, they calculate like the exact tensile strength of the steel cables. They factor in the maximum weight of rush hour traffic, the highest possible wind shear from a hurricane, and the structural integrity of the concrete. It's comforting because it's just pure, solid, undeniable math. You apply the formula, and the bridge stands firm over the water.
Right, but that's because that is a completely controlled environment. I mean, the engineers know the parameters, the variables are quantifiable, and they build these massive safety margins into the blueprint based on, historical data.
Yeah, exactly. But when you transition from engineering a bridge to engineering your financial future, specifically your retirement, suddenly you're trying to build that exact same bridge, but you're doing it in this thick, swirling fog.
Yeah.
You don't know exactly how far away the other side is. You don't know what kind of economic storms are, brewing in the distance.
You don't even know if you'll suddenly decide you want to drive a much heavier car halfway across.
Exactly. And clearing that fog is our mission today. Welcome to the Deep Dive. Today, we are decoding something called the Safe Withdrawal Rate method, or SWR. The ultimate goal is to help you figure out exactly how much you can spend in retirement without outliving your funds, while balancing that with actually enjoying the money you've saved.
Yeah, and the sources we're looking at today really break down the math, the limitations, and the general rules of thumb surrounding retirement withdrawals.
Okay, let's unpack this. We throw around terms like SWR, but let's lay a concrete foundation here. What is the fundamental mechanism?
So at its core, the safe withdrawal rate is it's a conservative financial strategy for retirees to determine an annual spending limit, but the underlying philosophy is the most important part. The whole goal is to live primarily off the returns of your investments rather than depleting the principal amount.
So it's kind of like a financial thermostat.
Right.
If you set it correctly, your portfolio stays at this comfortable temperature to sustain your lifestyle. But if you crank it too high, you basically bring the house down and run out of money.
That's a great way to look at it. And the traditional baseline that many advisors recommend is an SWR of about 3% to 4%, which is then adjusted for inflation every year.
Wait, let's pause on that inflation adjustment, just to make sure the mechanics of that are crystal clear.
Sure. So let's say your 4% withdrawal gives you $40,000 in your first year of retirement.
Oh, okay.
If inflation runs at 3% that year, things cost more. So for year 2, you don't recalculate 4% of your remaining portfolio. Instead, you take that original $40,000 and give yourself a 3% raise.
Oh, I see.
Yeah, so you pull out $41,200. You do this every year to maintain your purchasing power. What's fascinating here is that the SWR isn't just a blind guess. It's a defensive measure.
A defense against, like, major unknowns.
Exactly. Market performance, inflation spikes, unexpected, extraordinary expenses.
And frankly, your own individual life expectancy. I mean, the longer you expect to live, the longer you have to stretch your savings, which introduces even more variables outside of your control.
Right. Time really amplifies risk in retirement planning.
So a 4% defensive buffer sounds great in theory, but I want to take this from theory to practical application. Let's crunch the numbers and show exactly how this math works in the real world.
Well, the basic formula is straightforward. You take your desired annual withdrawal amount and you divide it by the total amount you have saved. That gives you your SWR.
Okay, let's look at a scenario from the sources. Let's say you've reached retirement. You have exactly $800,000 saved. You look at your budget and you determine you need $35,000 a year to live on.
If we run that math, 35,000 divided by 800,000, you get a 4.3% SWR.
Which is just above that traditional 3 to 4% range.
Right. It's pushing it a little. But if we want to show a lower risk scenario, let's say you realize you only need 25,000 a year.
Downsizing, no commute, that sort of thing.
Exactly. That drops your SWR down to 3.0%. At that rate, it is highly likely your funds will last.
But wait, what if I want to live large? What if I've worked my whole life and I look at my budget and say, no, I need $45,000 a year in retirement?
That's where you hit the danger zone. Taking $45,000 from an $800,000 portfolio yields a 5.6% withdrawal rate.
Oh, wow.
Yeah, that breaks the 4% rule entirely and significantly increases the risk of you running out of money. You're no longer just living off the returns, you're actively depleting the principal.
Here's where it gets really interesting, though. We can flip this formula upside down to reverse engineer our retirement goals.
We can. Instead of dividing the withdrawal by the savings, you divide your desired annual withdrawal amount by the safe withdrawal rate.
Right. So To safely withdraw that $45,000 using the strict 4% rule, you take $45,000 and divide it by 0.04. And that means you would actually need $1,125,000 saved.
Which means if you only have $800,000 right now, you need to save an additional $325,000 before retiring.
It's a huge reality check. The math works really cleanly on paper. But, the real world is messy. Reading through the sources, this 4% rule isn't exactly a one-size-fits-all law, right?
Not at all. There are some massive assumptions baked into the 4% rule, the biggest one being that it strictly assumes a 30-year retirement horizon.
But that feels like such an old-fashioned view of how life works now. I mean, what about people in the FIRE movement who want to retire early? They might be looking at a 50-year horizon.
Exactly.
Or people who want to continue working longer at a slower pace and don't actually need to draw down their savings for another 10 years?
If the 4% rule doesn't fit your specific needs, the plan absolutely must be adjusted. The 30-year assumption is just a baseline. And this raises an important question about where the money is actually kept.
Oh, the investment assumptions.
Right. The SWR method strictly assumes a conservative investment approach. We're talking investment-quality bonds, reliable dividend-paying stocks.
So definitely not throwing your nest egg into high-risk growth stocks or cryptocurrency.
No, absolutely not. If you apply a rigid withdrawal rule to highly volatile assets, the math breaks down because of something called sequence of returns risk.
Let's break that down. Sequence of returns risk.
Basically, it's the danger that the stock market crashes early in your retirement. Let's say you have $1 million entirely in a stock fund priced at $100 a share. You retire, you need your 4%, which is $40,000. To get that, you sell 400 shares.
Okay, making sense so far.
But what if the market crashes by 20% your very first year? The share price drops from $100 down to $80. Year 2 rolls around, and because of inflation, you still need your $40,000, but now your shares are only worth $80.
Oh, I see. To get the $40,000, you have to sell, what, like 500 shares?
Exactly. You are forced to sell off a much larger chunk of your actual ownership just to generate the exact same amount of cash.
Which means when the market eventually recovers, you have significantly fewer shares left to actually capture that upward growth.
Right. You've permanently locked in those losses. This is why the method requires stability.
But that highlights this really surprising limitation we found in the sources. Because there's a real danger in playing it too safe, isn't there? I mean, being overly conservative with your safe withdrawal rate might mean you settle for a much lower standard of living than you actually have to.
Yeah, people get terrified of this sequence of returns risk, so they live on, say, a 2% withdrawal rate just to guarantee they never run out of money.
You're living like a pauper to protect a fortune you'll never spend.
Exactly. Strictly maintaining these steady, rigid withdrawals despite economic changes is actually quite risky. The rigidity itself is the flaw.
So if the traditional rule is rigid and relies on old assumptions, how do retirees adapt today without needlessly sacrificing their quality of life?
The sources introduce an alternative approach called dynamic updating.
Dynamic updating, what does that look like?
It means regularly reassessing your withdrawal amounts based on current inflation and changes in the portfolio's value in real time. If we connect this to the bigger picture, the philosophy is simple. If your investments perform well, you can spend a little more. If they perform poorly, you consciously cut back.
It's like flying a plane. The traditional 4% rule is like flying on autopilot. It's great until you hit a storm, and then autopilot flies you right into the turbulence.
Right.
But dynamic updating is like actively grabbing the controls to steer around that market turbulence. And, your financial needs change. You might structure withdrawals to take 4% in the early years for travel and remodeling, your go-go years, and then drop to 3% in later, quieter years.
Exactly. Your spending curve is rarely a flat line. Dynamic updating gives you the flexibility to adapt to the market and your actual life.
So what does this all mean? The SWR and the 4% rule are classic foundational tools to ensure steady income for about 30 years, assuming your investments are conservative. But they aren't gospel. Dynamic updating provides a much more flexible, realistic alternative.
It really does. And I want to leave everyone with a final thought to mull over. We talked about how your desired withdrawal rate dictates how much you must save while you're working.
Yeah, the reverse engineering part.
Right. So if your desired retirement lifestyle directly dictates your current savings goals, how does knowing your personal SWR change the way you value a dollar earned today?
Wow, that's a great question.
Does understanding this math make you want to sprint toward the retirement finish line to fund a massive lifestyle? Or does it make you slow down and rethink what enough really means for your life right now?
That is definitely something to think about. Thank you all for joining us on this deep dive. We'll catch you next time.